हेलो एंड वेलकम एवरीवन, दिस इज प्रोफेसर सिद्धार्थ सुराना। आई होप यू गाइस आर डूइंग गुड और मैं तो हमेशा मस्त ही रहता हूँ। वेलकम टू एपिसोड नंबर 3 ऑफ रिवीजन कम अमेंडमेंट लेक्चर फॉर May 22 and November 22 एग्जाम्स प्रीवियस ईयर 21-22 असेसमेंट ईयर 22-23. In the last class we finished up till chapter number 9, that is investment funds. So we now go ahead, next chapter, chapter 10, very small chapter, bonus stripping. Basically, if you purchase the securities just before bonus declaration and you sell immediately afterwards, then the price before bonus will be higher than the normal market price. The price after bonus will be lower than the normal market price, and thus there will be some loss. This loss will be ignored and it will be made cost of acquisition of your bonus unit. So whenever a person purchases units, this provision is applicable only for units purchases within 3 months before the record date and transfers within 9 months. So the record date is the date on which you get eligibility for allotment of bonus. If your purchase transaction has taken place in the 3-month period before this and your sale transaction has taken place in the 9-month period after this, the provision is applicable only if purchase is within 3 months and sale is within 9 months, before and after respectively. Obviously you will be allotted bonus units, and now if there is any transfer of original units while you are holding the bonus unit, so on the original unit there will definitely be a loss. Why? Because this purchase price will be higher than the normal purchase price because of the eligibility of bonus, so higher than the normal market price. This selling price will be lower than the normal market price because the bonus benefit is taken, so now the price will fall, and thus there is always going to be a loss. The purchase will be at a higher price, the sale will be at a lower price, and which will result in a loss. This loss shall be completely ignored. The loss on original units will be ignored and it will be made cost of acquisition of whatever balance bonus units are remaining with you. So original units purchased within 3 months prior to the record date, sold within 9 months after the record date. On the original units there will be loss, that loss will be ignored, and that loss will be made the cost of acquisition of the bonus units that are remaining with you. Very small chapter summarized over here also in the form of a picture. So that was your chapter number 10, bonus stripping. Now we go to chapter number 11. The next few chapters, the last few chapters of volume 1, 11, 12, 13, 14, 15, 16, partnership firm, charitable trust, political party, electoral trust, MAT, AMT. Important chapters, so take this revision seriously. Specifically if I talk about the partnership part, so partnership has got one very big amendment, and these are revision come amendment lectures, so amendments have to be done in detail. There is nothing that I can tell you briefly, I have to do that in detail. So that one new amendment of 45(4), that we will take the recording of our full course lecture and I will show you that, because detailed explanation with numbers, with figures, it is not a revision, it is a detailed explanation. So that one amendment will be from that recording, and the remaining part we will be doing from our revision lecture, from the handwritten book, the way we are otherwise doing it. So let us understand first what is the chapter assessment of partnership firms. We are talking about assessment of firms, so obviously that will include partnership firms and it will also include limited liability partnership. For tax purposes, firms and LLPs are treated as same. So income tax treats firms and LLPs at par for tax purposes, and we will be learning the tax treatment of both firms and LLPs in this chapter. To start with, the basic tax. So when we did introduction, we do not cover tax rates of firms and companies, because firm tax rates we cover here and company tax rates we will cover in MAT chapter. Basic tax rate of partnership firm is going to be a flat rate of 30%. Flat means no basic exemption, no slabs, every rupee will be taxed at flat rate. So 100 rupees income, 30 rupees tax, 10 rupees income, 3 rupees tax. That is how tax will be calculated, flat 30%. After basic tax, obviously no rebate, because rebate is available only to individuals. So we have surcharge. Your surcharge will come only if income is exceeding 1 crore, exactly same as cooperative society in old regime. In new regime, cooperative society had compulsory 10%, 115 BAD. But in old regime, if income is more than 1 crore, then 12%, only one rate. So no 10, 15, 25, 37, nothing. Once income crosses 1 crore, then whether it is 10 crore, 50 crore, 100 crore, 1000 crore, only one rate of surcharge, that is 12%. So Income less than or equal to 1 crore, no surcharge. Equal to also no surcharge. Surcharge comes only greater than 1 crore, then only one rate of surcharge, 12%. And HEC requires no explanation after basic tax and surcharge. HEC is always going to come and always at 4%. So these are the income tax rates of partnership firms. Basic tax flat 30, surcharge only if income is exceeding 1 crore at 12%, and HEC at 4%. No basic exemption, no slabs, no new regime. Partnership firm is one of those assessees for which there is no new regime. So for individual HUF we have new regime, for company we have new regime, cooperative society also we have new regime. But good for you as a student, you have to solve only one total income, one total tax, because in those other assessees you have to solve both and see whichever is beneficial. So only one regime, and these are the rates of tax. Residential status, once upon a time it was not relevant, but now because of international tax, residential status will be relevant. Firm can be resident or non-resident. There is no further division into ROR or RNOR. That division is only for individual HUF. So firm will be resident or non-resident. That's it. And being an artificial person, there cannot be number of days. So we will be checking the control and management. If the control and management of the firm is wholly in India, obviously resident. If it is wholly outside India, obviously non-resident. If it is partly in India and partly outside India, the firm will be treated as a resident. Partly in India, partly outside India, the firm will be treated as a resident, or let me put it this way, one decision also of the firm taken in India, then it will be resident. A firm will be non-resident only if all decisions are taken outside India, and of course, there is no further division or classification into ROR or RNOR, only resident and non-resident. Next, a partner may receive multiple things. As a partner, you will receive salary, commission, bonus, remuneration. We use actually one word for all these things, remuneration. Whenever you are working partner, you will be given remuneration from the firm. So only working partners obviously will get it. And if you have provided funds, now you can be a sleeping partner also. If you have contributed to capital, then you will get interest on capital. So basically, there will be remuneration and interest that will be paid by firm to partner, firm to partner, firm to partner. And of course, at the end of the year, there will also be share of profit paid by firm to partner. So payments from firm to partner, we divide in three categories. One, remuneration for working partner, of course. Two, interest for anyone who has provided funds. And three, share of profit for all the partners in their profit sharing ratio. What is the difference in tax treatment? As far as the remuneration and interest is concerned, the firm is going to take deduction of these payments. It is like an expense of the firm, and because the firm will take deduction, they will be taxable. And also please pay attention, taxable under PGBP, because a partner is not an employee. So even if we call it salary, it will be taxable under PGBP in the hands of the partner, but only to the extent the deduction was allowed to the firm. So we all know there is a section 40B, a firm will not get full deduction of all the payments. Whatever is the payment made by firm to partner, we will restrict it to the limit of 40B. We will be revising that 40B limit also. Firm will get deduction only within the limit of 40B, and only that much will be taxable for the partner to the extent it was allowed to the firm. In other words, any amount which is disallowed to the firm. Disallowed means add back in the income of the firm. That means firm has already paid tax, and if the firm has already paid tax, then partner will not pay tax on the amount disallowed to the firm. Partner will pay tax only on the amount which has been allowed as a deduction to the firm. So remuneration and interest, expense of the firm, deduction as per 40B limits, and whatever is deducted, that much will be taxable for the partner under PGBP. But this last thing, share of profit, because the firm is an assessee, the firm has to pay tax. And because the firm has paid tax on the entire amount, the share of profit shall be exempt in the hands of the partner. So share of profit, firm will pay tax, partner exempt. Firm will pay tax, partner exempt. Firm will pay tax, partner exempt. Remuneration and interest, firm will pay take deduction, partner will pay tax. Firm will take deduction, partner will pay tax. Firm will take deduction only within the limit of 40B, and thus partner will pay tax only on that much amount. Only on that much amount. Next, presumptive taxation under section 44 AD for cash turnover 8% and for turnover realized in banking channels up to the due date of return filing 6%, and with effect from AY 22-23 even 44 ADA for professions 50%. So this is 6%, 8% based on mode of receipt and this is 50%, will be available only to resident firms. Only to resident firms. That means non-resident partnership firm not eligible. And in resident firm also, LLP will not be eligible. So what is the amendment? Till last year, 44 AD eligibility was resident individual, resident HUF, resident partnership firm excluding LLP. And now in 44 ADA there is an amendment. In 44 ADA, presumptive taxation of professionals. Earlier the rule was any resident assessee. Any resident. So resident individual, HUF, company firm, LLP, everybody was eligible. Now they have changed the eligible assessee here. Now as per the amendment, it is resident individual, resident firm. Resident individual, resident firm excluding LLP. That means, listen, first of all, HUF which was eligible is now disqualified. Companies etc. disqualified. And LLP also disqualified. Only resident individual, resident firm excluding LLP. So in other words, till last year, this was the only section where normal firm is allowed, LLP not allowed. Normal firm allowed, LLP not allowed. And this was the only difference in tax treatment between normal firm and LLP. Only one difference. Only one difference. Normal firm and LLP, only one difference. Only one difference. What? Normal firm eligible for 44 AD, LLP not eligible. But now that same thing will apply here also. Normal firm eligible, LLP not eligible. Normal firm eligible, LLP not eligible. The same thing will be applicable here also. The amendment is not here. The amendment is in 44 ADA. But we discuss it here so that we save our time at that point of time. In other words, from today onwards, if you are ever asked what is the difference in tax treatment between normal firm and LLP? Two sections. Which two sections? 44 AD and ADA. AD and ADA. Both available to normal firms, only if resident, not available to non-resident, but not available to LLPs. These are the only two places now. Till last year it was one, but now these are the two places where a tax treatment of normal firm and LLP will not be same. So that was about the presumptive taxation on partnership firm. Next section that we have, newly introduced section, section 9B. And if you understand 9B with me properly, then that amendment which I told you, a very, very complicated amendment. 45.4. Till last year, what was the rule? Firm transferring capital asset to partner. So 45.3 was partner to firm, agreed value. 45.4 was firm to partner, fair market value. Partner to firm, agreed value. Firm to partner, fair market value. Partner to firm, agreed value. Firm to partner, fair market value. There is no change in 45.3. So 45.3 is as it is, no change. But in 45.4, basically the full section is changed. They said in place of the existing subsection 4, we are bringing new subsection 4. Only subsection number will remain same, the entire content will change. And that new subsection 4 is a very, very complicated provision. The only way in which you can, only a brief revision is not going to help. Detailed learning is the only possible way of learning that 45.4, and that is why we have to make the compromise of doing that part of new 45.4 from the recording of our full, a complete detailed explanation. And in fact, if I incorporate that recording in my revision lecture, you will also get an idea about how detailed lectures and revision lectures are different from each other. Detailed lectures do not have any replacement. If you want to study, if you take ever, my suggestion, full course is the best way to study, and everything else basically crash course. If we don't have time, we are making compromise. Revision to can be done only if you have studied the full course, otherwise there is no point only of your revision. So 45.4 we will do later, but you will understand 45.4 only if you understand 9B properly, and 9B itself is also a newly introduced section. So transfer of capital asset or stock in trade. Two assets are being transferred. By whom? Firm, obviously. Firm will transfer to partner. And this same provision is applicable to AOP BOI also. AOP BOI will transfer to member. So two assets are being transferred. Which two assets? Capital asset or stock in trade. Who are the two transferors? Firm and AOP. And who are the two receivers? Partner for firm and member for AOP. That means firm to partner and AOP BOI to member. Firm to partner, AOP BOI to member. What are they transferring? It can be a capital asset or it can be stock. Any transfer of capital asset or stock in trade by firm or AOP to partner or member upon dissolution. Dissolution means we are closing the firm, no explanation required. Or reconstitution. Reconstitution is the same concept, change in constitution, which we have all studied. Change in constitution means what? Change in constitution means reconstitution. To do the constitution again. Admission of a partner or retirement of a partner in such a way that at least one old partner continues. Or change in profit sharing ratio. What are the two ways of change in constitution, reconstitution? Change in profit sharing ratio is one way. Second, admission or retirement. Admission or retirement in a way that at least one old partner continues. Admission or retirement in a way that at least one old partner continues shall be regarded as a transfer and it will be taxable. If the asset being transferred is capital asset, then there will be capital gains, and if the asset being transferred is stock in trade, then there will be PGBP. Capital gains or PGBP respectively in the year of transfer. Let me put it in simple language. Firm is transferring capital asset to partner or stock to partner. AOP is transferring capital asset to member or stock to member on any of the two occasions, dissolution or change in constitution. Then that will give rise to incomes. If the asset transferred is capital asset, then there will be capital gain in the hands of transfer. And if the asset transferred is stock in trade, then there will be PGBP in the hands of the transferor. It will be taxable as capital gain or PGBP respectively. So listen, two assets, capital asset, stock in trade, two transferors, firm, AOP, two receivers for the firm partner, for the AOP member, two occasions, dissolution or reconstitution, two heads of income. For capital asset, capital gains, for stock in trade, PGBP. This is the newly introduced section, and this has got connection with 45.4, no, because 45.4 was transfer of capital asset by firm to partner. So if the asset is stock in trade, only this provision will apply. But if the answer is, if the asset transferred is capital asset, then how will 9B and 45.4 together apply? That is the new complicated concept, and thus we have to do that in detail. But for that, understand 9B properly. You understand 9B properly, then you understand 45.4, and then you understand the joint applicability of 9B and 45.4. At least for now, are we clear about 9B? Two assets, capital asset, stock in trade, two transferors, firm AOP, two receivers, firm to member and AOP to firm to partner, AOP to member, two occasions, dissolution or change in constitution, two heads of income, capital gain for capital asset and PGBP for stock in trade. And for this purpose, the FMV of the asset transferred shall be considered as the sale consideration. So whichever head of income, whether capital gain for capital asset or stock in trade PGBP, the fair market value will be treated as selling price. The CBDT shall issue guidelines with the approval of central government, which will be laid before both the houses of the parliament. And what is the meaning of reconstitution? Same as per section 187 also. It can be change in PSR or it can be admission or retirement that at least one old partner continues to be the partner. Same hai, absolutely same. Okay. So this is the newly introduced section, in which that way if you think, sir, only the stock in trade part is new, because capital gain part was already there in 45.4, but that section has also completely changed, and because of that we will need to do a detailed learning. But I hope we are clear about 9B. In short, capital asset or stock in trade transferred, then capital gain or PGBP will arise, and FMV of the asset will be taken as selling price in the respective head of income. Now when we go to the capital gain part, at least in 45.3 there is no change. So whenever a partner transfer capital asset to firm, partner transferring capital asset to firm, the sale consideration will be value recorded by the firm in its books of accounts, that is agreed value, ignoring the fair market value. No change here, no change here. Partner to firm, partner to firm, partner to firm, 45.3, absolutely no change. Transfer of any asset by partner to firm, 45.3, absolutely no change. So value recorded in books of accounts, that is the agreed value, will be taken as the sale consideration. Okay, as it is, no change. But the change that is taking place is going to be the new section 45.4, when firm is transferring capital asset to partner. Now 9B also says the same thing. 9B covers both, but stock will cover only 9B. But if it is capital asset, then 9B is also applicable. 45(4) is also applicable. How 9B and 45(4), this newly introduced complicated provision, reading part you can do from here, because that explanation from our full course, whenever I do full course, there is no PDF that I open. The entire income tax is by heart. I do everything in writing and teaching. That is how the full course works. So that part we will be doing from our full course. This 45(4) part, once we do from the full course, we will take that recorded video and you will be understanding what exactly is happening. We will now go to 45(4). Before we go to this provision 45(4), I would first want that you please just a quick recap of 9B, because without 9B you cannot understand 45(4). What is a section 9B? Just a quick recap. Transfer of two assets. What are the two assets covered over there? Capital asset and stock in trade by two assessees, firm and AOP BOI, to their owners respectively. That means firm to partner, AOP BOI to member. Correct? Will result in taxable income. If the asset is capital asset, then which income will arise? And if the asset is stock in trade, then which income will arise? And in both cases, for both cases, whether capital asset or stock in trade, whether capital gain or PGBP respectively, both cases for the firm or for the AOP, the sale consideration will be taken as fair market value, and this can happen on two occasions. What are the two occasions where 9B will be invoked? Dissolution or reconstitution. Reconstitution means admission or retirement. At least one old partner should continue. Correct? Okay. And now we also have section 45(4). First understand what is the transaction. Whenever there is a firm or AOP BOI, so this provision is also applicable to AOP BOI. In fact, 45(3) also, transfer of capital asset from partner to firm, also covers member to AOP. Okay, but we will restrict ourselves to discussion on partnership firm. Has transferred any capital asset or money. What is getting transferred? Transfer of capital asset or transfer of money. Now tell me, firm will transfer to whom? Partner. And AOP will transfer to member. Then 45(4) will get invoked. Then 45(4) will get invoked. And once again there is a particular calculation given here. So the whole confusing aspect out here is, I will of course teach you the calculation, but what is the confusing aspect out here? Please pay attention. These two, capital asset and these two, are these three things common with section 9B? Are these things common with section 9B? The transferor is firm or AOP, asset is capital asset, and the transferee is partner or member. And here the occasion given is reconstitution. Only one. So what were the two occasions or the two events given as far as your 9B is concerned? Dissolution and reconstitution. But this section 45(4) will be applicable only in case of reconstitution. What is reconstitution? Admission or retirement, at least one old partner should continue. Then 45(4) ka calculation will also come into picture. What is that calculation? That we will learn with examples. And problem is this, that when the section was enacted in the budget, by plain reading of the section, there was a particular interpretation which was drawn by all of us in creating the books and the lectures. Till now ICAI has not released anything in the form of database of this provision. Nothing is released. In fact, many a times ICAI Board of Studies checks what we have done in our books, how we have interpreted, and then they accordingly modify their understanding of the provision. But Recently, few days ago, income tax department, that means CBDT, the papa, the daddy of income tax department, has released a circular on interpretation of 45(4) and 9B. And the numerical example that I will today cover with you in class is exactly taken from the CBDT circular. CBDT ka means released by government, that they have given, they have only understood, Nirmala aunty knows that the amendment that I have brought is so confusing that no one will understand. So she only gave examples also, and we will do example exactly from the circular itself, directly from the circular, which if you understand, even ICAI cannot contradict, because that is the law given by the government. Okay, but first let's understand the computation of 45(4). Before that, let's understand the applicability. Firm or AOP? What is the asset transferred? Capital asset or money? What is the occasion? Reconstitution. And transferee is partner or member. The problem is that in 9B also transferor was firm and AOP. Transfer of capital asset was covered. Reconstitution was covered. And transferee was partner or member. And that means if these four conditions, first condition, second condition, third condition and fourth condition, if these four conditions are fulfilled, then 9B and 45(4) will be invoked simultaneously. And both calculations will happen together. So if you have to learn only the calculation of 9B, it is very easy. I think you all have understood also that. If you have to learn only 45(4), it is very easy. But the moment you have to bring both of them together, the calculation is very, very complicated. And thus we have to learn that. But before that, see if you have the brain to understand the following things. Therefore, you know, that is how I would like to explain, make it easy for you. Please use your brain and understand. If the transfer is of only stock in trade, means capital asset is not transferred or money is not transferred, then do you understand? Only 9B will be applicable, 45(4) will not come into picture. PGBP income will be computed by taking FMV of the stock as sale consideration. Let me be clear about the interpretations, because simultaneous invoking will happen only when four conditions are fulfilled. Second, let me see if you are understanding. If it is only money, that means neither stock in trade nor capital asset. Only money is transferred at the time of reconstitution. Let me be clear about that. Only stock in trade. This can be dissolution or reconstitution. Both cases, only which section will apply? 9B. Only money and only reconstitution. Which section will apply? 45(4). If it's a case of dissolution, in that case, whether the asset transferred is money, stock or capital asset. Come on. For stock and capital asset, section 9B will be applicable. Listen, Sainath and everyone else, 45(4) cannot apply because 45(4) is only for reconstitution. So the moment it is a case of dissolution, that means 45(4) cannot come. If these two assets are there, then 9B will come. If they are not there and it is only money, then for 9B will also not come. But one thing is for sure, on dissolution 45(4) will not apply. On dissolution only 9B can apply, 45(4) cannot apply. That means these are cases where only one of the two sections will apply. And now understand this. If it's a case of reconstitution, and along with reconstitution there is a transfer of capital asset. If it's a case of reconstitution and it's including capital asset. It may be with or without money. Money may be a part of the transaction. Money may not be a part of transaction. But till the time it's a case of reconstitution and transfer of capital asset. Now tell me one thing. Is reconstitution with capital asset covered in 9B and 45(4)? Both. This is a case where both sections will be simultaneously invoked. Okay. So now at least are we clear when 9B will come and when 45(4) will come? Answer to the question when is clear. What is the calculation is going to be our next step. First, I will teach you calculation of 45(4) because 9B calculation is already done and it's very easy. I will tell you the calculation of 45(4). With that, you will be done with 9B also and you will be done with 45(4) also. And then I will teach you how both provisions will be simultaneously invoked. At the time of initial interpretation, with the plain reading of the law, the interpretation was a little different, but with the circular, the interpretation is changed. So now I will be covering the interpretation exactly as per government circular. But before that, first let's understand the calculation of which calculation we have already studied out of the two sections. At least that much you are clear. You should be clear. 9B is over. So which calculation we have to learn? 45(4). Are we 100% also clear of when which section will apply? We have referred to all the conditions. Chalo. So let's first learn the calculation prescribed in 45(4). What is 45(4)? Capital asset or money. Correct or no? And at the time of reconstitution, capital asset or money at the time of reconstitution. Correct or no? So listen what is happening. There is a partnership firm which has transferred, and by the way, I am writing firm in my example. Are we clear that here along with firm we will also cover? And along with partner we will also cover. This partner is getting capital asset or money. At which occasion? Change in constitution, reconstitution, that is admission or retirement. At least one old partner should continue. Of course, if we are giving it to the partner, that means he will take and go. So mostly this must be the retiring partner. Most probably that will be the case. He is the retired partner, retiring partner, and that means there must be some balance in his capital account. Think about it. Think about it. I am a partner. There is some balance in my capital account. Take an example. What is the balance? You know, I am a partner in a firm. I decide to leave the firm. That becomes a case of retirement. The other partners are continuing. That means it becomes a case of reconstitution. So the share in my account, my remaining capital balance, the firm will pay me and then I will go, no? Take an example. What is the balance in the partner's capital account? Net balance. Huh? And before you take the example, capital account, current account, by whatever name you call that, total outstanding, total payable by firm to partner. What is that balance? Take an example. Take an example. 10 lakh rupees. 10 lakh rupees is the capital balance. So if the firm pays me 10 lakh rupees, I will leave. Can I say that's transfer of money at the time of reconstitution? Alternatively, it is quite possible that the firm does not have cash bank balance, it does not have liquidity. Is it possible? In that case, the firm will transfer maybe any of the assets to the partner. Tell him that we don't have money. You take one land or one building, take this asset and leave. That means in conclusion, what is happening is for the balance lying in the capital account, we are giving some money to the partner and then the relation of the firm and the partner is over. This transaction is now going to attract capital gains for the partner. Capital gains for the partner. Think about it, compare him with a shareholder. Compare him with a shareholder. You buy shares. One day at the time of liquidation, your shares will become a worthless piece of paper. But against those shares, at the time of liquidation, either you can get money or you can get asset from the company. Yes or no? So the money that you receive or the asset that you receive is like your selling price. And the actual purchase price of shares will be subtracted and we get capital gains at the time of liquidation. Same concept will become applicable here. We will compute capital gains of the partner. How will we compute capital gains of the partner? Sale consideration for the partner will be whatever money we are paying him. Can I say we are paying this, matlab we are giving money to the partner, that becomes sale consideration. Along with the money, what else we are possibly giving to the partner? What else are we giving to the partner possibly along with the money? So we will take fair market value of the asset. Money plus fair market value of the asset. That is going to be taken as sale consideration. Money plus fair market value of asset. And now what we will be subtracting from this? Because what is capital gain? Sale minus cost, no? Now, with what I have explained till now, would you like to guess what will be taken as cost of acquisition? I made you compare it with the shareholder so that you can probably answer. What do you think will be taken as cost of acquisition? The balance, not just the initial capital contribution, but today's balance in his capital account. Today's balance in his capital account. So, which we took as an example. What example we took? We took 10 lakh, no? See, it is possible that initially he contributed 5-6 lakh rupees. Then over the years, share of profit must be continuously credited in partner's capital account. Yes or no? Every year we must have earned profit and credited. There may have been occasions where there are drawings. We are checking the net balance in the capital account. The net balance in the capital account will be the cost of acquisition. To simply put that way, what was the balance in our example? 10 lakh. Against that 10 lakh, I am getting this money and this asset. So this is my sale consideration and this is my cost of acquisition. And this will become which income? Capital gains. Capital gains for whom? Partner is getting this against this balance. So who is earning this gain? Partner. So who is the person who is earning the gain? Partner. But open your eyes clearly, ears clearly and see what government has done. Government is saying gain will keep on arising to partners. There will be partners who will come, who will go, partners will come, will go. We cannot run behind individual partners. Like in buyback tax, we cannot run behind individual shareholder. Every time a shareholder agrees for buyback, it is capital gain for the shareholder, no? Buyback price minus purchase price. But we cannot run behind individual shareholder for recovery of taxes. So what concept we have introduced in our country? On the behalf of the shareholder ka capital gain, we are making whom pay tax? We will do that only here also. The capital gain is arising for whom? Partner. But tax on this gain amount has to be paid by the firm. Gain will arise to the partner. How will you compute the gain? Money plus FMV will become selling price and balance in capital account will become cost price. Whose capital gain is this? Partner's capital gain. But we will make whom pay tax? Firm will pay tax. This is the line. This one line is the concept of the new 45.4. The gain is of the partner, but tax we want from the firm. And we are understanding it like this because anyways, if the firm is paying tax, then automatically that much amount is reduced now from the net worth of the firm. Automatically, indirect beating of the tax will be taken by the partners only. So gain of the partner will be taxable for the firm. What is 45.4 in one line? Gain of the partner will be taxable for the firm. And how do we compute gain of the partner? Whatever he has received. What can he receive in 45.4? Stock in trade cannot come. In 45.4 what can come? Money or capital asset. That's selling price. What is cost price of the partner? Balance in capital account. And who will pay tax on that gain? Firm. With respect to this, there are a couple of points to be noted. I just want to clarify with respect to the calculation because You may definitely have that doubt, at least the intelligent students. First point, this I already told you, that when we are taking balance in capital account, are we taking balance in capital account? This balance in capital account can be in any manner. Arey, matlab I told you no, that 10 lakh rupees can be total of capital account, current account, everything together is total of 10 lakh. You know, some firms have got fixed capital, floating capital. You have done transactions like this in your accounting. So we will take that total, because he is leaving, no? We will take total balance, capital account, current account, everything total. Understood this point? That when we are taking balance in capital account, it can be any manner. Second, this should have definitely come as a question to you. Should have come. If it did not come, no problem. Is it possible that the net amount is coming as negative? Yes. Supposingly, money plus fair market value of asset is only 8 lakh rupees. And what was the capital balance in our example? And in any manner ka concept understood? Capital account, current account, everything total? 10 lakh rupees, 8 minus 10 negative, then no need to pay tax. There is no concept of giving loss benefit to the firm. If there is gain to the partner, we will take tax, but not from the partner. Who will pay tax on behalf of the partner? Firm will pay tax on behalf of the partner. Okay? And if it is a loss, if it is negative amount, then what will we do? Take it as 0. We will take it as 0. Is that clear? Is that clear? And third point. This first point was applicable only for this part. Balance in capital account can be taken in any manner. Capital account, current account, anything. Likewise, this third point is also applicable only to that balance in capital account. Only to that part. Okay, what is written in the third part over here? They are saying that while taking the balance in capital account, we will ignore any kind of revaluation. Otherwise, what will happen? Imagine, there is supposedly land worth 10 lakh rupees. Okay, let's say asset side, there is land 10 lakh. Don't write this, I'll do a proper example just to make you understand what is happening. Liability side, there are two partners with capital 5 lakh, total 10. Can I say asset side, liability side, total? Correct or no? That means if at all we are taking cost of acquisition for any of the partner, the balance in capital account is the cost of acquisition 5 lakh rupees. What this firm will do is, they will revalue the land to 1 crore. That means here we will increase 90 lakh rupees. And we will credit 45 for both. So 5 lakh will convert into 50 lakhs. And purposely we will inflate our cost of acquisition. Not allowed. Understood the line? When we are taking balance in capital account, we will ignore any kind of revaluation. You cannot increase the balance in capital account with revaluation. For the purpose of the calculation of 45.4, you will not be allowed to increase the balance in capital account because of revaluation. Is that clear? Or any self-generated goodwill. Any self-generated asset or goodwill. Sir, now what does this mean? Let me do that example again. What was the value of the land? 10 and two partners 5 lakh each. If at all a situation of 45.4 arises, in case 45.4 arises, that means can I say cost of acquisition of 45.4 will be 5 lakh whether it is partner A or partner B, because that is the balance in capital account. Achha, if we want to increase cost of acquisition, we can take land at fair market value and increase cost of acquisition, no? We can take land at fair market value, increase the value of the land here, accordingly increase these balances. Revaluation is not allowed. So you all have understood that point, no? Revaluation is not allowed. Idea, another idea. Listen Listen, dear income tax department, our firm is a very old firm, reputed firm. People respect us for our commitment and business. We are very famous in our business. Mostly we have monopoly in our business. Everybody comes to us only in our business. We have got great goodwill in the market. So we are not revaluing our existing asset. You told us not allowed, no? You told us not allowed, no? We are not revaluing that, but we have goodwill of 90 lakh. So take goodwill here, and correspondingly, what will we do in the partner's capital account? We will increase 45. That also not allowed. That is what I wanted you to understand here. So when we are taking balance in capital account, it can be capital account, current account, anything. But while taking that balance, you cannot take any revalued asset. You cannot take any self-generated goodwill or anything. You cannot revalue any asset, because with that you will only artificially inflate the balance in capital account. And why is the assessee doing this? Artificial inflation of balance in capital account will result in increase of your cost of acquisition. That is cost of acquisition, which will reduce your capital gain, which will reduce your tax liability. Do you understand the ripple effect here? One affecting the other. Very ripple effect. You have heard this term before? One thing affecting the other. Yes. So are we clear on? Are we clear on the calculation aspect of 45.4? Simultaneous invoking of 9B and 45.4 we will be doing, but are we clear about the calculation aspect of only 45.4? Gain will arise to whom? Partner. But we will take tax from whom? Firm. Gain will arise to partner, but we will take tax from the firm. How will we compute that? Selling price will be money plus FMV of asset. Cost price will be the balance in capital account. If negative, then take it 0. Ignore any revaluation or self-generated asset, and capital account can be in any manner. That capital gain will be taxable for the firm.
So, negative balance in capital, then COA will be nil, right?
If the final answer, this net result is so, that is why for point 1 and point 2, for point 1 and point 2, point 1 and point 3, I have taken the arrow. Here when we are saying if negative, we are talking about the capital gain amount. If the gain is negative, then we will ignore it. If the gain is negative, then we will ignore it. We will take it as 0. Point 1 was for cost of acquisition. Point 3 was for cost of acquisition. Point 2 is for capital gains part. Okay. So listen once again.
Sorry, but here what the transfer is for. So gain should be for, right? So
that means you have not understood what is happening here. Partner is having stake in the firm in the form of capital account. Ownership in the firm. That ownership is getting over. I am selling that ownership ek tarike se. You understand that? How am I selling that? I am taking away some asset and money and leaving. So the other people will get the gain of that. No? They will get the increase in profit sharing ratio. No? So the gain is for the partner. Anyways, tax we are taking from the firm only. Okay. So listen, quickly tell me, if it is transfer of only stock in trade, 9B will apply. Selling price will be FMV of the stock. Correct or no? If it is transfer of money, only money, then this section will apply. 45.4, money paid to the partner minus capital balance in the partner will be capital gain of the partner and taxable for the firm, subject to the 3 points that we have studied over here. No problem. If it's a case of dissolution, then whether you give capital asset or whether you give stock in trade, calculation will be as per 9B. But now, if it's a case of simultaneous invoking of 9B with 45.4, then what will happen? If 45.4 and 9B happen together, then what will happen? First of all, when will they happen together? If the asset is capital asset and the transaction is reconstitution. If it is capital asset with reconstitution, then both sections will be invoked simultaneously. When 45(4) was enacted at that time by the plain reading. The feeling was that first we will invoke section 45(4), finish the calculation of 45(4), and then we will invoke the calculation of 9B. First 45(4) will come and then 9B will come. That will be the chronology of applying the provisions. But in the recently released circular, by whom? ICAI, not ICAI. In the recently released circular by CBDT, they have said your step 1 will be do the calculation of 9B. First step will be 9B and second step will be 45(4). Are both sections applicable simultaneously if these two conditions, capital asset and reconstitution, are fulfilled? Are both sections applicable simultaneously? So initial interpretation was, because there was no clarity. In fact, right now also in big seminars of ICAI, nobody knows what is happening. There was not enough clarity. So plain reading got or gave us a feeling that first we will be applying 45(4), then we will be applying 9B. But government has made it clear by releasing a circular. What will happen first? 9B will be invoked first, and after that what will happen? 45(4) will be applicable after that. It's a recent circular. You'll find it on income tax website also. But I know that you are not going to do it, and I will do one thing. I will directly take an example directly from that circular. They have taken an example where we have a balance sheet of a firm. Name of the firm in that circular, they have taken some FR or something, anything like that. You can take any firm. What is the name of the firm? ABC firm. We are taking any name. It is only an example. So please tell me, what is the name of the firm? ABC. It has got land. Land S, land T, land U. All three were purchased for 10 lakh rupees whenever they were purchased in the good old days. So what is the total book value of the three lands? Total 30 lakh. 30 lakh. And there are three partners, A, B and C. The balance in the capital account of each of the three partners is 30. Very simple tally of balance sheet. No problem. Mitro. No problem. Initially, they gave only this much as an example. Of course, if we want, we can add assets also. You want, you can add asset. You can have cash bank balance. You can have stock in trade. Let me increase that. Say we have cash bank over here. 40 lakh rupees. Is it possible? Hello? We have stock in trade. Say 30 lakh. So of course, for liability side, we have to tally something, no? Say creditors are 25 lakhs and we have loan. How much? 45. Is your balance sheet now telling it 100? Just check the amounts. Arey, please check the amounts and tell me things in the form of yes or no. Yaar, you can't do that much also. What? Okay. Now it is decided that partner A will leave the firm. Leave means he retires from the firm. B and C are going to continue with the firm. So that means, can I say this is a case of change in constitution? Reconstitution? And when partner A will go, now listen, if partner A is going and we give him only 30, only stock in trade worth 30 or anything from our stock in trade, if we give him this, then only 9B will be applicable.
Yes.
If we give him only this, then only 45(4) will be applicable. But in case the partner is going and we give him any of the lands, supposingly
Both 9B and 45.
this was given to A at the time of retirement, then in that case, do you understand, 9B and 45(4) both will be simultaneously applicable.
Yes.
So as per initial interpretation, we thought first 45(4) and then 9B. But now, as per the circular, as a clarification, they have said step 1, you will apply 9B. 9B means calculation of capital gain or stock in trade. If the asset transferred is a land, then which actually 9B covers both capital asset as well as capital gain as well as PGBP. But in our example, if the asset is the land which is given, land U to the partner, then which income will arise? Capital gain will arise or PGBP will arise? Capital gains will arise? Yes or no? For that we will need fair market value, because mind you, the 10 lakh that we have in our books is, historical cost purchased many years ago. So the ICAI income tax ka, the example that they have given in circular, they have given us FMV also of the 3 lands. For land, I'll just write it over here. Of land S and T, what is the book value of these 2 lands? 10, but the fair market value is 70 lakh. And land U, which is an important land in our discussion, because let me remind you that for A on retirement, which land are we giving him? U, where the book value is only rupees 10 lakh, but today's fair market value is 50 lakh. Today's fair market value is 50 lakh. 10 lakh maybe the cost of acquisition also, no? Because cost of acquisition only historical cost we have written in accounts. Possible or no? Hello? So what is happening is, we are giving away our land to our partner, and along with the land, the example says, along with the land, is this land being given to partner A? Upon his exit, along with the land, we are also giving him some money as per the example which they have given in the circular. Do we have some money also to give him? Let me remove it from here. So from that we are giving him 11 lakh. This is the total paid to partner A upon his exit. So let's have the entire recap of the story so far. How many partners in the firm? A, B and C with 10 lakh each in the form of capital. The firm has got 3 lands. All 3, the book value is 10 lakh, but the fair market value is different. For 2 lands, it is 70 lakh, and for the land which we are giving to our partner, it is 50 lakh. And we are not just giving that land, we are also giving our partner even 11 lakh in cash. And of course, we have also written the other assets and liabilities. Because it is a case of reconstitution and we are giving capital asset, that means 9B and 45(4) both will get simultaneously invoked. As per the circular, step 1, you have to apply 9B. 9B means transfer from firm to partner. What is the asset that is being transferred from firm to partner? Of course, in 9B we don't take the money. 9B takes only capital asset and stock in trade. And in this case, it's land. That means, can I say there will be capital gain on the firm? What will be the sale consideration? Fair market value 50 lakh minus. Now listen. Acha, by the way, this capital gain is for firm. That too, I hope you don't have any confusion. 9B calculation, you remember, no? Capital gain on the firm. From sale consideration, you understood how 50 lakh the fair market value? We have to subtract cost of acquisition. Question has assumed it is long term and thus it is index cost. Supposingly it was short term. Please use your brain and understand. Supposingly if it was short term, then this would have been our cost of acquisition also, because we must have recorded the land in books at our original cost only, no? But they have assumed it is long term. That means, can I say 10 lakh has to be indexed, and they have taken directly example that the index cost of acquisition is 15 lakh. Means 10 lakh after indexation will increase, no? Hello? So they have written a line in the circular. Let's assume that after indexation, the cost of acquisition is 15 lakh rupees. So what is the long term capital gain on the firm? 35 lakh. 50 lakh is selling price and 15 lakh is cost price. That means long term capital gain will be 35 lakh rupees. No problem. On this 35 lakh rupees, the firm will have to pay tax. On this 35 lakh rupees, the firm will have to pay tax. Long-term capital gain will be taxable at 20%. We have already studied that this rate of 20% will also be applicable. And therefore, there is going to be tax of rupees 7 lakh. Correct? Of course, you know this, I know this, that 7 lakh cannot be the final tax liability. Hello? 7 lakh cannot be the final tax liability because there will be HEC also. But for the purpose of ease of calculation, this is again from the circular. For the purpose of ease of calculation, for the time being, they have said, of course, we all know there will be HEC, but ek kaam karo, for the time being, ignore surcharge and HEC. Ignore. Just assume that 7 lakh is final tax liability. Of course, is it a right assumption? No. But they have said assume. So that calculation is easy. Otherwise, now we will calculate HEC. Then we will have to waste time in doing that calculation. Anyways, the objective is to make you understand the concept. So understand the concept very clearly. We have invoked 9B. 9B ke andar we have to take fair market value of the asset as sale consideration.
Yes.
So we have taken 50 lakh. Of course, money cannot come in 9B. Money comes only in 45.4. So we have taken 50. Cost of acquisition was 10. But assuming long term, we have taken example of index cost as 15. Capital gain of 35, resulting in tax of 7 lakh. That means the first step of the firm will be to pay tax of 7 lakh rupees. First task of the firm is to pay tax 7 lakh. That is the tax liability arising as per which section? 9B ke according, this is going to be the, according to 9B, this is going to be the tax liability. And after doing this as per 9B, tell me one thing, 9B is a part of your accounts or income tax? No confusion over there, no? Because the circular, the whole provision is very, very confusing. So pay attention now. 9B is a part of income tax. When you do this, 7 lakh is your tax liability for the time being, ignoring HEC. But there will be some book adjustments also, no? Computation under tax will have index cost. But in books, we have only 10 lakh cost. Do you understand that?
Yes.
So in books of accounts, what we will have to do? We will have to remove our land. So we will have to take selling price as 50 lakh rupees minus the cost of acquisition. As per books, what is the cost of acquisition? In accounts, we don't have index cost, no? 10. So what is the profit that we will record in books of accounts because of our land? 40 is the profit that we will record in our books of accounts. In this 40, we will also have tax liability. That also has to be recorded in books, no? How much is the tax that we have paid as per tax calculation?
12 lakh.
The tax here, if we would have taken HEC, then we would have to incorporate our decimal points and all that. That is why they have assumed ignoring HEC. What is the net profit as per books? So the profit as per tax is 35. The tax as per tax is 7. But the profit in books will not be based on index cost. The profit in books will be as per the book value of the land, no?
Yes.
And thus, what is the net profit which is being shown? 33. Are you with me?
Yes.
33 lakh. This you will have to send where? Take a guess. You will have to credit where? Credit in partners capital account, that is A, B and C will get a credit. After invoking 9B, we will calculate profit as per tax, pay the tax. But we will also calculate profit as per books, and that profit after adjusting the tax liability will be credited where? In partners capital account. And therefore, now the balance where? In partners capital account. What was the balance in partners capital account when we started the story? But now it is going to be. Do you agree with this? Do you agree with this? because this is the adjustment as per books of accounts. By the way, we are not interested in the capital balance of B and C. We need capital balance for 45-4, no? We need capital balance, no?
Yes.
Whose capital balance are we interested in? The outgoing partner, that is A. And now we will use our step number 2. What is step number 2? 45-4. What is 45-4? Capital gain computed for the partner, but taxable for the, what is sale consideration? Fair market value of the asset being paid to the partner, 50 lakh. You remember the example, or shall I scroll up? 50 plus money also we are giving. In 9B we don't take money. In 9B we don't take money, but in 45-4 we have to take money, no? So what is the total sale consideration? What do we take as cost of acquisition in 45-4? Balance in partner's capital account, represented in any manner, but not taking any self-generated asset or goodwill. So supposingly this 21 lakh which is there in all the 3 partners ka capital account, please listen to me. Supposingly there was some current account balance also, 5 lakh. So we will take that also. Supposingly there is some asset revalued and because of that you have credited 1 lakh. So we will subtract that. So we will do the adjustments that we have written. But in this example, we don't have any such thing. So what is the balance in capital account? 21. And this 40 lakh will be again taxable under capital gains. This 40 lakh will be again taxable under capital gain. For whom? For the firm. This will be taxable for the firm. Now this is unfortunately resulting. Acha, by the way, this is how we will invoke, before I go to further discussion, this is how we will simultaneously invoke 9B and 45-4. What will be our first step? 9B. And what will be our second step? 45-4. And as far as the calculation is concerned, I have done the respective calculation. In 9B, I have done 9B ka calculation. After doing the profit as per tax, we found out the adjustment in accounts. Accordingly, the revised balance of capital account because of the transaction that has taken place, that will be helping us in finding out our cost of acquisition of 45-4. So first 9B and then 45-4. That discussion is clear over everyone? But this is creating one problem, and rightly so. Think about it. Is fair market value of asset included here? Yes. And that means the firm has paid tax on that fair market value of 50.
Yes.
And the fair market value is again getting included here. The firm is again paying tax. This is a little unfair to the firm. A little unfair. So dear partnership firm, don't worry. The 40 lakh that you are paying tax on today is actually on behalf of your partner.
Yes.
But this is resulting in double taxation on the firm because the FMV was already taxed in 9B already for the firm. From the firm's point of view, if you observe, is it not unfair to take tax on the same amount again? So this 40 lakh that you are paying today, this is your taxable income. If I do one thing, that in future, this 40 lakh, I give you deduction in capital gains. Today you are paying tax, future may on one day, which is that day I will tell you. That's our third step and the concept will get over. In future, there will be an occasion where we will give you deduction of this 40 lakh. That means today you pay tax, but no problem. In future you get deduction. That means today's taxable income and future ka deduction will cancel each other. That means whatever you are paying tax today, one fine day it will get cancelled. That with that day when you get deduction. And that means in effect you have paid tax only once. What is that last question that we have to answer? When will the firm get deduction? When will the firm get deduction and where will the firm get deduction? When and where? Are you understanding? That is our third and the last step. Step number 3, which is section 48. Section 48 is the section of computation of capital gains. When this asset got transferred, okay, look at the remaining capital asset. What were our remaining capital asset? S and T. Where? What was the book value? 10.
lakhs each.
What is the fair market value?
70 lakhs in total.
70 lakhs in total. That means, can I say total 20 lakh became total 140? So I have written S and T only. No?
Total liability is 70 in the example. So it is each.
No problem. Tell me, what is the total increase from book value to fair market value? Total increase? 120. In what proportion? 1:1? 1:1, no? Equal only, no? Supposingly, one land would have become 10 lakh ka 40 lakh and other land would have become 10 lakh ka 70 lakh. That means the total increase would have been, 60 plus 30, 90 lakh, then the proportion would have been 1:2 or something. But here, can I say the increase in the value of both lands is equal? Whenever these lands will get sold, there will be capital gains. Sale consideration will be actual sale consideration if I take land S and land T both. Actual sale consideration. Whenever you sell any asset for that matter, actual sale consideration. There will be some index cost of acquisition, which is mostly going to be 10 lakh, which was our original cost, indexed till that year of sale. And we will also give deduction of 40 lakh. Total deduction of 40 lakh in proportion of increase from book value to fair market value. What was the proportion? It was 60 lakh for both of them. That means, can I say equal proportion mein the fair market value increased? That means 20 lakh ka deduction we will take here and 20 lakh ka deduction we will take here. Whenever the other assets will get sold in future, against their capital gains, we will take the deduction. Let's take another example, because this was an easy example, you may not understand. Let's take another example. Okay, supposingly this land ka value became 40 lakh. This is contradicting with our original example. I am changing the example. I am doing a new example with you. One second. Supposingly this land ka value became 40 lakh and this land ka value became 70 lakh. Let's take a little complicated example. Okay. So what is the total here? 110. What is the total increase in fair market value? 90. And in what proportion that 90 has increased? 30:60. So when we take deduction of 40 lakh here, what we will do? Over here, we will take 40 into 1/3 and 40 into 2/3. In the proportion in which book value increased to fair market value, in that proportion 40 lakh ka deduction will be taken against our continuing fixed assets. Understood? If it's a case of dissolution, all the fixed assets will go away. If all the fixed assets, dissolution, everything will go away, no? All fixed assets will go away. because all fixed assets will go away. We will not be left with any remaining asset to apportion this. Now 45(4) is not applicable only, no boss. That is why only 9B is applicable. 45(4) is applicable only in case of. तो हो गया ना फिर. Understood? So whatever is the increase in the circular ka example, both have increased by 60-60. So 40 ka deduction will be taken as 20-20. But I did another example also. I want to stick to the circular wala example, and therefore I am changing this back to this. But you can alternatively have another example also with you, wherein the increase is of different amounts. Accordingly, the deduction will also be in that proportion. But I am confining myself to the example given by government in its circular. This is how we will simultaneously invoke 9B and 45(4). I would like to once again give you a quick recap from start to finish of 9B and 45(4). See if everything is clear from start to finish. First, let's talk about only 9B. Firm or AOP BOI. Just keep on listening. See if you are understanding everything. Firm or AOP BOI. To partner or member respectively. That will cover reconstitution and dissolution both. In fact, dissolution is covered only in 9B. If it is capital asset, then capital gain. If it is stock in trade, then PGBP, and both cases fair market value will be taken as selling price. 9B, very easy. Now let's talk about 45(4). 45(4) is applicable on firm or AOP. If it is money or capital asset, only reconstitution, not applicable on dissolution. Only capital asset, only reconstitution. What is the calculation in 45(4)? Calculate capital gain of the partner. How to calculate capital gain on the partner? FMV of the asset plus money paid minus the balance in capital account. That's his gain. And who will pay tax on this gain? Firm will pay tax on this gain. Gain of the partner taxable for the firm. While taking the balance in capital account, remember two things. First, capital account represented in any manner, whether capital or current account. Second, if there is any revaluation or self-generated asset, ignore that. And third thing, if the capital gain is coming as negative, then ignore 45(4). It won't apply only. But when both sections will happen simultaneously, actually only that is confusing. If you have to apply 9B alone, there is no confusion. If you have to apply 45(4) alone, there is no confusion. Confusion comes only when you have to apply both sections together. When you have both sections together. By the way, when do we have both sections together? When it is capital asset and reconstitution. When it is capital asset and reconstitution. What will apply first? 9B. Take selling price of course it has to be capital asset. Had it been stock in trade, then only PGBP will come and 45(4) won't come only. Take selling price as FMV of that asset. Will we include any money paid in this calculation? No. In 9B we won't. Only FMV. Take index cost of your asset. Find out the gain. Find out the tax. Of course, in actual sum the tax has to be with cess. In example, for convenience purposes, we ignore cess. Find out that tax. Pay that tax. Till that duty is over, 9B ka duty is over. Now do the book adjustment also, because after earning the profit and paying the tax, there is a net profit left which will be credited in partner's capital account. So the balance in capital account will increase. And now apply 45(4). Take the fair market value of the asset, take the money, subtract the increased balance from the capital account. That will give you the net profit of 45(4), which will again be taxable for the firm. But because the FMV is getting taxed twice, we will give you the amount that you are paying tax on today. We will give you that deduction in future. Against which you will get deduction? Your remaining capital asset ke samne you can take that deduction. And in what proportion? In the proportion in which their fair market value increased today, in that same proportion you can take deduction against the capital assets, and accordingly the 40 that you are paying tax on today will get reduced one fine day in future. That is how simultaneously 9B and 45(4) simultaneously are going to be invoked. Welcome back. Maza aaya in the recording. What's more important is, I strongly believe that the entire concept of the newly introduced concept of this complicated provision 45(4) is clear. This is the problem. One section, but so much incorporated. Auntie has made us all go mad. So imagine to teach this in 1 hour. how many hours I must have spent to first read and understand. And he's making life really, really very difficult. Continuously incorporating so many complications. No one, including herself, is able to understand the taxation laws. GST ka condition we all know. Poor guys, sometimes I feel sorry for indirect tax faculties. Supposingly faculty has taught something with a lot of passion in class, full power, full energy, taught everything. He comes out of the class and then he is informed that it is already amended. But that's how it is. Now that 45.4 is over, let's move on with our chapter. Partnership firm. We have already studied that tax rate of partnership firm is flat 30%. But in case the firm has got any 111A, short-term capital gain on stock market, 112A, long-term capital gain on stock market, 112, any other long-term. See, long-term is always special rate. It can be any of these two, year or year. Short-term will be special rate only if it is 111A stock market. All other short-term like land, house, gold, jewelry, they all go in normal rates. But these three are special rates and they will also be applicable to the partnership firm. We do not want any confusion here. Sir, you taught us that partnership firm has got flat 30, flat 30, flat 30. And thus will all these incomes go in flat 30? No, sir. These incomes will continue to be taxed at their applicable special rates. Special rates will continue to apply on these incomes. Okay. And normal income will be taxed at flat rate of 30%. Next, set off and carry forward chapter. If there is any partnership firm loss which is attributable to an outgoing partner other than unabsorbed depreciation, because assets remain with us, so UAD can be carried forward. But supposingly there are three partners and they are sharing profits and losses in the ratio of 2:1. So there is a loss, we apportion the loss 2:1. Out of that, one partner leaves the firm. Then only this much loss can be carried forward by the firm. That loss shall not be allowed whether by the firm or by the individual partner. Whenever there is an outgoing partner, his share in the loss will lapse. There will be no carry forward. Loss pertaining to an outgoing partner other than UAD, because only the partner is going, the asset is with us. Loss pertaining to an outgoing partner, there will be no carry forward allowed to the firm. Next, you want to call yourself a firm, you can join hands with anyone. High five. We are partners. But for income tax, to call yourself a firm, there are three conditions. Condition 1, the partnership deed has to be in writing. So oral partnerships not allowed. Condition 2, the deed should contain manner of sharing profit, basis of sharing profit. It can be in percentage 60-40. It can be in ratio 2:1. It can be fixed amounts. Every partner will get 5 lakh share of profit every year. But there has to be some basis, some manner of sharing profit, and a copy of deed shall be submitted along with the first ROI. So if you fulfill three conditions, then only you can call yourself a firm. You fulfill three conditions, then only you can call yourself a firm. And if there is ever a change in constitution, then you should furnish a revised copy of partnership deed. So three conditions, then only you can call yourself a firm. Three conditions, then only you can call yourself a firm. And in case there is violation of any of these conditions, you will still be a firm. You are still a firm, but you will not get deduction under 40B. That means, in other words, if you fulfill these three conditions, then only you get 40B deduction. Otherwise, you will not get 40B deduction. And of course, if the firm is not getting deduction, then nothing will be taxable in the hands of the partner, because we have already studied partner will pay tax only on the amount which has been deducted for the firm. So if the firm is not getting 40B deduction, the partner will not pay tax on any amount. If the firm is not getting deduction, the partner will not pay tax on any amount. So three conditions fulfill, then only you are a firm. Deed in writing, manner of sharing profit, submit the deed. If the condition is violated, still a firm, but no 40B deduction. And of course, nothing will be taxable for the partner. Next, change in constitution, already explained while explaining reconstitution. It can be change in PSR, or it can be admission or retirement. At least one old partner should be continuing. Then the old and the new will be treated as the same firm. There will be only one assessment. But in case there is succession of a firm by another, that means all the partners change, because if at least one old partner continues, then it becomes change in constitution. So what will be the meaning of succession? When a situation not covered by 187, or in other words, can I say all partners are new, all the partners change, then there will be two separate assessment, one on the old firm, one on the new firm, one on the old firm, one on the new firm. The old firm and the new firm will be treated as two different assessees. The old and the new firm will be treated as two different assessees, and here we have two judgments. First, Supreme Court judgment, Empire Estate and Iyer Narappan and Company. If the deed is silent about what will happen in case of death, if any partner dies, what will the remaining partners do? If the deed is silent, excuse me, then we will be treating it as a case of succession. If the deed is silent, it will be treated as a case of succession. But if the deed contains a clause of continuation, then it will be treated as change in constitution. So if the deed says that firm will continue, then only it is change in constitution. If the deed is silent, it will be treated as succession. It will be treated as compulsory dissolution of partnership firm. Next, section 188A. Whenever there is any liability, any kind of liability, tax, interest, penalty, any other sum payable, who will be paying? Who will be paying? All the partners are jointly and severally liable. Joint and several means we can recover full tax from one partner. Whenever there is anything payable, all the partners are jointly and severally liable. However, if there is any deceased partner, then that liability will be recovered from the legal heir or the legal representative of the deceased partner, and it will be restricted to the value of the estate inherited by the legal heir or the legal representative. In other words, maximum liability equal to inheritance. The legal heir will never be made to pay anything from his own pocket. So let's simplify this. Liability in a firm is on the partner. Which partner? Joint and several. If there is any deceased partner, then legal heir, and maximum liability will be equal to the extent of the amount of inheritance. Maximum liability equal to inheritance. But what if the firm has dissolved? What if the firm has dissolved? In that case, how will we decide the liability? For any continuing proceeding, for any fresh proceeding, for settling any outstanding tax liability, the dissolved firm will be deemed to be in existence. You may have done dissolution. You have done dissolution, but income tax will de-recognize that dissolution till the time all your outstanding dues are not settled, till the time everything is not paid. The dissolved firm will be deemed to be in existence. Till the time everything is not settled, the dissolved firm will be deemed to be in existence. That is going to be the liability even after dissolution. Now comes an important question that, sir, you told us that liability in a firm is joint and several, and all tax provisions applicable to firm are also applicable to LLP except 44 AD and ADA as per amendment. All tax provisions of firm and LLP are same. That means joint and several liability is also applicable in LLP, sir. Yes. Then what is the point of opening LLP? A person has opened LLP so that I get immunity from that liability, unlimited liability. And thus, on a liquidation of LLP, if partner proves, it's only if you prove that the non-recovery of tax is not attributable to, not due to his negligence, his breach of duty, his misconduct, then he will be absolved of joint and several liability. So, first question, is there joint and several liability in LLP also? Yes. But you get immunity only if you prove. So, if you are not able to prove, there is joint and several liability. This facility is available only to partner of LLP, not available to partner of normal partnership firm. Not available to partner of normal firm. This facility will be available only and only to partner of LLP. This facility will not be available to partner of a normal firm, because LLP should get that additional benefit. And here, do not make a mistake. Sir, you said between normal firm and LLP only one difference, presumptive. Now you are teaching one more. This is not difference between the firms. This is difference between their partners. This facility is available to the partner of LLP, not available to partner of normal firm. This tax difference is difference between the partners. This is not a difference between the firms. Between the firms, there is only one difference, that is presumptive taxation. Now focus please. In a partnership firm, joint and several liability, deceased partner legal heir, maximum liability, inheritance. Same rule in LLP also. Same. But only if proven, that partner will get immunity. Only if proven. So there is joint and several liability, but you escape if you prove. Escape if you prove, and only partner of LLP, not available to partner of normal partnership firm. Next. if there is any income which is received after dissolution. So, for outstanding liabilities, dissolved firm will be deemed to be in existence and we will apply joint and several liability. But if there is a new income, now there is no firm. For settling your outstanding liabilities of the period when there was the firm, we will treat you as deemed to be in existence. But now we cannot create a new firm. So, if there is income which is received like bad debts recovered, now there is no firm. So, obviously, that income will be received by any of the erstwhile partners and it will also be taxable in the hands of receiving partner because there is no firm. Sir, you said dissolved firm will be deemed to be in existence only for the purpose of recovery, not for the purpose of creating any new income. So, dissolved firm will be deemed to be in existence only for the purpose of recovery. Now, income will be received by partner, taxable for the partner under the head income from other sources. Received by the partner, taxable for the partner under the head income from other sources. Last two things, one, we have case laws on stock valuation and then the 40B limits. Stock valuation, two Supreme Court judgment, ALA firm, Shakti Trading Company. In both cases, firm has been dissolved. If firm has been dissolved, on the date of dissolution, we have to make final accounts to find out the income and tax till now. Here the business stopped. Obviously, firm has dissolved, so business will stop. Then stock will be valued at net realizable value. But here business continued. Example, firm converted into company. Firm dissolved, but business is continuing. Firm converted into proprietorship. Succession, one firm dissolved, another firm starts. Business continues. Then Supreme Court said continue the normal accounting method. FIFO, LIFO, weighted average, whichever you are following, cost or market price, whichever is lower. So, if business stops, then NRV, and if business continues, then normal accounting method. But you can cancel this part from now because with effect from AY 1718, so it's been already few years, there is income computation and disclosure standards ICDS on inventories which will override the ruling of Shakti Trading Company and say that once there is dissolution of firm or AOP, in fact this is applicable to both firm or AOP, firm or AOP, firm or AOP, once there is dissolution, then it will always be at net realizable value. If there is dissolution of firm or AOP, then the valuation will be always at net realizable value, whether your business continues or stops, the valuation will be always at net realizable value, always at net realizable value. And if there is any conflict between court ruling and ICDS, let me be clear, let me put it like this, ICDS versus case law, if there is ever any such fight, ICDS versus case law, let me be clear, the ICDS will be superior to the case law. The ICDS will override the case law like it did with Shakti Trading case law. And finally, we come to the limits. Limits means, can a firm pay more than this? Yes, sir. The limit is on deduction. The deduction of interest or salary, commission, bonus, where you can use one word, remuneration, paid to the partner by the firm. Let's talk about the interest first because it is very easy. Deduction is going to be least of the following. Actual amount of interest paid, obviously we come to know that from the P&L account. Amount as per the partnership deed, which will also be given, and 12% per annum simple interest. Actual deed or 12% per annum simple interest, whichever is lowest will be allowed. This interest can be paid to working partner or sleeping partner both. Interest is paid for providing funds. Even if you do not participate into the day-to-day activities, interest is paid for both working and sleeping partners because this is for providing funds. Interest will be payable not only for the capital but also for loan given. Opposite set off is not allowed. So, there is interest on capital, interest on drawings. So, you cannot take the net amount. The gross amount will be subjected to the limit. Gross amount will be subjected to the limit. Okay. The limit of 40B shall be applied only if interest is paid to a partner and not in any representative capacity. Supposingly X is partner and we pay interest to X is Y for X HUF, then 40B will not be applicable. 40B is applicable only and only if the receiver is partner, and of course, whatever will be allowed as a deduction to the firm will be taxable in the hands of the partner. This is the treatment of interest. You should remember the three limits. You can be tested on MCQs also. There are some complicated MCQs. We are doing revision series first, then we will go to MCQs so that when we do MCQs, you remember the provisions. So, Suggestion is that tell your friends, whoever are not watching the lectures every day, tell your friends to watch the lectures with me live every day, because if you watch them now, then immediately after we go to this, we have MCQs. Huge number of students, they said, sir, baad mein dekhega, baad mein, later. Then exam came, they could not watch all the lectures, then they regret, if I would have seen everything, then I would have got good marks in direct tax. I do not want that concept of regret at all, and thus, if you are watching, continue it, and if your friends are not watching, they are waiting for a later date, let me tell you, that date will never come. So give them this good suggestion, please. Let's go to the deduction of remuneration, which will cover salary, bonus, commission, everything. Deduction will be least of, the limit is still least of the three. So there will be actual remuneration from the P&L account as per deed, which will also be given, and then as per 40B limit, for which you have to see if there is a book loss, then there is one flat answer, 1,50,000, and if there is book profit, then you have to apply slabs. First 3 lakh, 90% of book profit, balance 60%. First 3 lakh 90, balance 60. First 3 lakh 90, balance 60. But this still will be minimum 1,50,000. It cannot be less than 150, because simply because if there is loss, say book profit is -1, book loss of 1 rupee, then we are getting 150, and book profit is plus 1 rupee, then we are applying 90 paisa. That is unfair. So negative book profit, that means book loss up to infinity, 1,50,000. Positive book profit, minimum 150, minimum 150, minimum 150. Apply 90%. If that is less than 150, then minimum 150. So if your book profit is 1 lakh, 150. Book profit is 1 lakh 20, 30, 40, 50,000, 150. At book profit of 1,66,667, if you are interested in knowing. Here if you apply 90%, you get 150. That's the indifference point. After this, you will get your answer by applying 90%, and of course in the second slab after 3 lakh it will be 60%. So if your book profit is this amount or less than this amount, up to negative amount anything, you should get 1,50,000 only as your answer. So in case of book loss, 1,50,000. In case of book profit, first 3 lakh 90, balance 60, but still never less than 1,50,000. Listen, this is the third limit. The brightest students make such a big mistake, such a big stupidity, such a big nonsense. Some bright and talented students, if they get book loss, they directly write 150 as the answer. No boss, compare with the other two. So actual deed or 150, whichever is lower. If you are getting book loss, 150 is your third limit. What if actual is only 40,000, 50,000, 80,000, 90,000? Then actual deed or 150, whichever is lower. Actual deed or this amount, whichever is lower. Remuneration will be allowed. Book profit calculation I will teach you. Remuneration will be allowed only if it is paid to working partner. If it is paid to sleeping partner, it will be fully disallowed. Fully disallowed. Whatever limits you are applying is going to be annual limit for all the partners together. This limit is not per partner or per month. Whatever answer you get is the final answer. You don't multiply by number of months and you don't multiply by number of partners. This is the final answer. And here book profit contains only business profession income. Just to remind you, and anyways that chapter is coming very soon. In MAT also we calculate book profit, but the book profit which we calculate in MAT, that book profit contains all the 5 heads of income. But here in partnership form, the book profit will contain only, PGBP income, and thus we will be calculating as per PGBP provisions. Start with net profit as per profit and loss account. Do all your PGBP adjustments. What are the PGBP adjustments? Expenses which are debited but disallowed, added in PGBP. Incomes which are not credited but taxable, you add them. Expenses which are not debited but allowed, you less them. Incomes which are credited but not taxable, you less them. If you observe carefully, these are the general PGBP adjustment. PGBP chapter also, if you open, you will get these adjustments. Net profit and these 4 adjustments will give you your taxable PGBP. But what are the extra adjustments? Interest and remuneration, whatever is debited, add them fully. Add them fully. Whatever is allowed, we will calculate it separately and give the deduction. For example, in interest, actual deed or 12%, whichever is lower. In remuneration, actual deed or third point depends on book profit or book loss, whichever is lower. We will allow that separately. Okay. But as of now, add the amount debited fully. Add as per books, subtract less as per tax separately. And now we get PGBP before 40B deduction. So we have solved all adjustments of PGBP. We have disallowed the amount debited. We just have to give deduction. For this interest deduction, you don't need any book profit. You have already calculated it. Actual deed or 12%, whichever is lower. So add the interest as per books, less the interest as per tax. After taking this interest deduction, if you understand, there is only one thing remaining. Only one thing remaining, that is the remuneration allowable. Only one thing is remaining, that is the remuneration allowable. If we give that, we will get our PGBP. This can be called the PGBP before remuneration deduction under section 40B. Only one thing is left. If I subtract from this amount the remuneration that is allowed under section 40B, if I subtract that amount, in fact, I will end up getting my taxable PGBP also, and that amount will be called book profit. That amount just before remuneration deduction. Only one step is left. This will be your book profit. If positive, then first 3,90,000, balance 60, but minimum 1,50,000. If negative, then 1,50,000. But that's the third limit. Compare with actual and as per deed, whichever is lowest, give that deduction, and you also get your taxable profits and gains of business or profession. So that was the revision of our partnership chapter along with the detailed discussion of 45.4. Understood? Now that the chapter partnership firms is over, actually we may or may not be able to complete, but let us at least start our next chapter. If I do little also in the remaining time that I have for today, then in the next class I will be able to complete your full volume 1. In the next episode, episode 4, your volume 1 will get over. So let's start at least the starting part of the next chapter, assessment of charitable and religious trusts. Charitable and religious trust. Of course, with the name itself, we know that they are going to be eligible for some exemption, and the quantum of exemption is 15%. But before that, you have to satisfy conditions, and before that, you should know the meaning. So we will be first learning meaning of religious and charitable trust, then what are the conditions to get exemption, and finally, once that is done, how much exemption is going to be available. Religious trust is a trust which operates for religious purpose, but religious purpose has not been defined. So take in common parlance, take the Siddhivinayak temple of Mumbai, take any of the dargahs or mosque, masjid, take any of that, take the Mount Mary Church, very famous, take the Golden Temple of Amritsar. If I am not wrong, I had picked up this image from Google. So this is the Tirumala temple of, we call it Tirupati Balaji. This is that temple. Any of these places will be basically your places where religious purposes are being done, and thus the trust which is operating this place will be called a religious trust. Religious purpose has not been defined, but a charitable trust is a trust which operates for charitable purpose which has been defined. So if you do this, then you will become a charitable trust. So what do you mean by charitable trust? Let's go and understand. First, relief for the poor. That means you are providing food, clothing and shelter to the poor people. Example, favorite. Second, medical relief. Example, any of the hospitals. So Fortis Hospital is the one which I have kept here today in this book. Next, schools and colleges. Education. So we have a school kids here, last 2 years they didn't go, but now they are all going. Yoga. Only one gentleman comes to our mind when we talk about the term yoga. Preservation of two things. Which two things? Objects and monuments of artistic or historic interest. So whether it is a museum, whether it is a fort, this is the Red Fort. Preservation of objects or monuments of artistic or historic interest, or preservation of the environment, where environment will include wildlife, watersheds and forest. For wildlife, we have the example of Save the Tiger. For watersheds, we have the Narmada Bachao. For forest, we have the Chipko movement. So if you are doing any of these activities, or advancement of any other object of general public utility, anything which helps the general public. For example, a water fountain at a public place. So this was incorporated by our organization. This is an actual image. This is a public toilet somewhere in Mumbai. This is me only donating blood. So any of these activities conducted by, this was a blood donation camp conducted by the same organization where I am the vice president. So here this was the blood donation camp. Same organization has also installed a public water drinking fountain. So any of these activities which helps the general public. Relief for the poor, medical relief, preservation, yoga, education and any other object which helps the general public. However, for the sixth point, we have two conditions that if this trust is carrying out commercial activity. So these two are applicable only for the sixth point, not applicable for the other five. One, the commercial activity must be related to your charitable activity. The commercial activity must have been done in course of your charity. And second, your commercial receipts should be maximum 20% of your total receipts. The commercial receipts should not be exceeding 20% of your total receipts. Maximum 20% of your total receipts. But these conditions are not applicable for relief for the poor, medical relief, education, yoga, preservation. Only in the advancement category. If you are doing commercial activity, then related and 20% limit. Related and 20% limit. And apart from that, what are the conditions which are applicable to all the trusts? These two conditions are applicable only to the last trust, but these conditions are applicable to all the six trusts, all the six. Relief for the poor, medical relief, education, yoga, all of them. What? You need to be registered with the Commissioner of Income Tax under section 12A, for which procedure is given in 12AB. This is the new procedure. The old procedure 12AA is now deleted. Books of accounts have to be maintained. Every time we have books of accounts, goes without saying, we will have the next condition. Books of accounts have to be audited. Your return of income has to be filed on time, and your unused funds, the income that you have received but not yet spent, they should be kept invested in the modes given under section 11(5), where in the main textbook you can read all of them and learn any 5. So register, books of accounts, audit ROI on time, and unused funds should be kept in the modes given under section 11(5). If you fulfill these conditions, then only you are going to be eligible for your exemption, and these are applicable to all 6. Plus these two are extra applicable only for the advancement category. So advancement category will have 2 extra, and then any trust doing business, there are 2 more conditions that we will also see later. But as of now, 5 conditions applicable to all the trusts, 2 conditions applicable only for the advancement category, for which only this registration condition requires detailed explanation. Others are very easy. Books of accounts, audit, ROI has to be filed on time, utilization of funds. Only the registration has to be done in detail. So let's go point by point. Every trust in its lifetime will have to take 3 registrations. 3 registrations. First, to give yourself birth, to call yourself a trust, you have to register with a person called Charity Commissioner. Only when he grants his registration, you can call yourself a charitable trust. Otherwise, you will not be treated, called, or considered a charitable trust. Second, you have to register with the Commissioner of Income Tax under section 12A. Once you do this, so basically this is the second registration of your life. The first registration is registration with the Charity Commissioner. This is your second registration in life. Then if you do this registration, you will be getting your exemption. And third, you need to register under section 80G, so that your donors also get deduction. So if I give donation to a trust, I will get deduction if the trust has taken 80G, and trust will get exemption if the trust has taken 12A, because both these registrations are done with the same person. Many a times trusts make joint application also under both sections. Only this person is different. So first registration with Charity Commissioner, and the other 2 under income tax. First for own exemption, second for donors deduction. Here we will discuss only 12A. Whenever you apply for registration, registration shall be in force from the year of application. The registration will be prospective. If you create a trust in 2010 and you apply for registration in 2021, your registration will come into force from 21. There is no concept of retrospective registration. But for the past years, we will not be doing any scrutiny or reassessment, because if we start doing that, then the trusts will avoid registering and they will always remain in the cash economy, parallel economy. We want them to come in the main channel, so there will be no scrutiny or reassessment of past years. If a trust is doing modification of its object, any kind of modification of object you do, you will have to apply for fresh registration within a period of 30 days. If you do modification of objects, you will have to apply for fresh registration within a period of 30 days. Once you register under this section, obviously you will be eligible for 15% under section 11. 15% is the main exemption of this chapter. 15% exemption is allowed, but you will not get any section 10 exemption. For example, that buyback tax exemption, you will not get that. If the trust is partner in a firm, that share of profit exemption, you will not get that. Once a trust takes this registration, that means the trust wants this exemption, and if you want this exemption, we will not give you any exemption under section 10. Section 10 not allowed, except means these exemptions, there are 3 total, these 3 will be allowed. So any trust which is registered cannot take section 10 exemptions like share of profit from firm or 1034A, buyback tax exemption where the company has paid buyback tax, so shareholders capital gain is exempt. Not allowed, but 3 allowed. Which 3? Agriculture income exemption under 10(1) will be allowed. Second, if it is a medical or educational institution, then 1023C is allowed. 1023C is allowed to 3 trusts, any of the 3, it is or. So you can be in any of the 3. You can be in any of the 3. First, owned or financed by the government. So government school, college, hospital will take full exemption in 1023C. Second, the gross receipts is up to rupees 1 crore, and here there is an amendment. This 1 crore limit is now increased to 5 crore rupees. So trust having total receipts, gross receipts from fees, bills, etc. up to 5 crore. And also a clarification that if a trust is doing both activities, education and medical, there are so many organizations which do both activities, education and medical, then 5 crore shall apply on the total. You don't get 5 crore for education, 5 crore for medical separate. We will apply on total. So what are the 2 amendments? Amendment 1, the limit of 1 crore turnover for 1023C is increased to 5 crore. And second, that 5 crore will be the total of education and medical activities. And third, your trust has to be approved by the CCIT. Only if the trust is approved by the CCIT, this benefit will be available. If the trust is not approved by CCIT, then this benefit will not be available. This benefit is available only if the trust is approved by the CCIT. Only if the trust is approved by the CCIT. So basically, you can fall in any of the 3 categories. You don't have to fulfill all the 3 cumulatively. Government, school, college, hospital, nothing to check. Whether approved or not approved, irrespective of turnover. Then turnover up to 5 crore, nothing to check. Or approved by CCIT, nothing to check. If you fall in any of these 3, you are eligible for 1023C even if you are a registered trust. वैसे normally registered trust is not allowed to take section 10 exemption, but this is an exception. So agriculture will be allowed, 1023C will be allowed, and 1046. Any body, authority, board, trust, commission, for example, I have given you Competition Commission of India, it can be UPSC, Union Public Service Commission, any of these organizations which are established under an act, not doing any commercial activity, most of them are government owned only, but not doing any commercial activity, and notified in this regard. When you fulfill the 3 conditions, established under an act, not doing commercial activity and notified, established under an act, not doing commercial activity and notified. When you fulfill these 3 conditions, then you are eligible for 1046, and you can take 1046 even if you are a registered trust. So the conclusion is, normally a trust which is registered will not get any exemption under section 10 except 3 which will be allowed: agriculture 10(1), second educational medical institution 1023C, and third 1046 which is available to a body, authority, board, trust, commission. These 3 are going to be allowed. Any other section 10 will not be allowed. The moment you get your registration under 1023C or you get your approval under 1046 here, then your old registration will become inoperative. You cannot use both together. So if you are using this, you cannot use this. You cannot use this. The moment you get registered, your 12AA or 12AB shall become inoperative. But there is a risk. What if someday you are removed from here? Or what if someday you are removed from here? Is it possible? Then if you are removed from 1023C or 1046, then you will not get section 10 exemption. And if you don't get section 10 exemption, then you will want section 11 because something is better. You can apply again under 12AB to become operative, but only on one condition, that now you agree that these 2 sections, 1023C and 1046, will never be available to you ever again in life. They will be permanently unavailable, permanently inapplicable to you. So in short, you register, no section 10 exemption except 3. In these 3, if you are 2 require, agriculture does not require any approval or notification, but 2 require. So if you are approved or notified, then your section 11 not allowed, because 12AA will become, 12AB will become inoperative. And if you want to make it operative again, then the only condition to make it operative again is that you agree that section 10 shall not be available to me lifetime. For lifetime, I agree to forego, leave section 10. Then in that case, these registrations will become operative. This will become operative again, but section 10 will not be available ever. That's our rule for registration under 12A, for which the procedure is given in 12 AA. This was the old procedure, and now we have new procedure. Okay, so actually you should focus only on 12AB, but very quickly. Earlier it was a very small procedure. Trust will make application, CIT you have to apply, huh? We already saw that. CIT will make inquiries, CIT will also check compliance with other laws. So if you are registered as, you know, a company, section 8 company, then it will check compliance with company law. If you are registered under Indian Trust Act, so it will check compliance with that law. If you are registered under the Societies Act, so it will check that. Whichever is the other law applicable, it will check that also. And CIT will pass an order within 6 months from the end of the month of application, whether the registration is granted or the registration is denied. Before denying, you have to follow PONJ. PONJ stands for Principle of Natural Justice, where basically every judge before taking action against you will ask you, do you want to say something? Kuch kehna hai? Do you want to say something? Question mark. In the web series from which this uncle I have taken, actually the uncle says, I want to say something. He says, mujhe kuch kehna hai. But here I have put a question mark. And because I put question mark, that means you have to understand that here the judge is asking you, do you want to say something in your defense? In Hindi movies they show, आपको आपकी सफाई में कुछ कहना है, you want to say something in your defense to support yourself. That is called natural justice. Principle of natural justice. That means assessee will be granted, assessee will be given a reasonable opportunity of being heard. That is called principle of natural justice. Then only it will be denied, and even after denial, it is going to be appealable at ITAT. Denial of registration will be appealable at ITAT. Okay. And now we talk about the new procedure. In case of violation, CIT can cancel the trust, registration of the trust. There also he will have to provide you opportunity of being heard, and that is also going to be appealable. So just like denial, for cancellation of registration also opportunity has to be given, and that will also be appealable. Now let's talk about the new procedure, under which, if I have to summarize, earlier you used to get lifetime registration. Once you are registered, unless there is violation and there is cancellation, lifetime registration. What activities you are doing, nobody is asking, nobody is checking. There are so many thousands and lakhs of organizations in our country who took registration as trust and did all illegal and immoral activities. And thus our government has changed this system completely. They now say that registration of any trust will have maximum 5-year validity. Registration of any trust will have maximum validity of 5 years. At the end of every 5 years, you will have to renew your registration. And at that time, we will ask you, what have you done in the last 5 years? We want to check. They will check your activities and they will check whether you deserve renewal of registration. That is going to be taking place. Okay. So, all existing trusts will have to apply within 3 months from the enactment of section 12AB. It was enacted on 1st June 2020, but because of COVID, that 3 months kept on getting extended. Short and simple, all the existing trusts from Kashmir to Kanyakumari, from Gujarat to Arunachal Pradesh, every trust of the country will have to apply for fresh registration, and the CIT will decide within 3 months from the end of the application month whether I want to grant registration or no, and that registration, if granted, shall be having a 5-year validity. That means now if your registration is about to expire, you will have to apply for fresh registration, and every registration will expire after 5 years. Supposingly you are a newly formed trust. If a newly formed trust may not have done activities, so we will not grant you proper registration. We will grant you something called provisional registration. You apply at least 1 month prior to the commencement of the previous year, and we will give you a 3 years provisional registration by passing an order within 1 month from the end of the month of application. It will be valid for 3 years. Temporary provisional registration, we will check whether you have done proper charitable activities and convert your provisional registration into proper registration. Any trust whose registration is about to expire, so we are talking about this trust, 5 years registration about to expire, then at least 6 months prior to such expiry, you will have to apply. And newly formed trust whose provisional registration will expire within 3 years, then you also have to apply 6 months prior to the expiry, or if you commence activities, then at that time, whichever is earlier, 6 months prior to the expiry or commencement of activities, whichever is earlier. And now we will give you fresh registration within 6 months from the end of the month of application, and from now onwards all the registrations will be valid for 5 years. So only provisional registration will have 3-year validity, all other registrations will have 5-year validity. Modification of objects within 30 days. I already told you there was a trust. Remember whose 1023C and 1046 resulted in 12AB becoming inoperative, and now you want to make 12AB operative again, then that also has to be done at least 6 months prior to the relevant assessment year, and again that registration will be granted for a period of 5 years. This is the period of registration, validity period of registration, how you will apply, when you will apply, in how much time CIT will pass the order, all that is given here. Other points are same. CIT will make inquiries, he will also check compliance with other law, and finally he will decide whether granted or denied. Denied only by giving PONCH, means opportunity of being heard, and that denial is going to be appealable at ITAT. And again, in case of violation, if there is violation by the trust, then CIT can cancel. Violation of income tax law, violation of any other applicable law, any violation by the trust, then the CIT can cancel, but only after PONCH, and it will be appealable at ITAT. Only after giving an opportunity of being heard, and that will also be appealable at ITAT. The same as 12AA. If you observe, these points are same. The only thing that has changed is the whole scenario of expiry of registration and then again applying, expiry and then again applying. 5 years. Only provisional will be 3 years. All the other registrations will have validity of 5 years. Last small concept I will do in today's episode. Then remaining part of charitable trust we will continue tomorrow. And because we have done so much, then in the next episode, episode number 4, we will be able to complete charitable trust, political party, electoral trust, very small, MAT, AMT also. We can say in the 4th episode, we will be able to complete our volume 1 completely. So business income. First of all, trust is allowed to do business. Nowhere it is written that doing business is not allowed. But doing business will come with the following condition. Condition 1, you have to maintain separate books of accounts for every business. And condition 2, the business should be incidental to the main objects of the trust. The business should be incidental to the main objects of the trust, where incidental does not mean that the business should be related. Incidental, Supreme Court has decided in 2 judgments, Dharmodayam and Thanti Trust. Incidental means the profit of the trust should be used for charity. So any trust doing business, profit has to be used for charity. That is the meaning of incidental. That business and charity have to be related was only for advancement category. The business and charity have to be related was only for advancement category. Here incidental means profit should be used for charity. So let me keep it simple. First thing, are trust allowed to do business? Yes. 2 conditions. Separate books and profit used for charity. Any trust which is not doing business, for normal trust there are 5 conditions to get exemption. 5 conditions. Registration, books of accounts, audit, file ROI on time, and utilization of funds. 5 conditions applicable to all the trusts, whether you do business or you don't. Now if a trust is doing business, then there will be 2 extra conditions. Separate books and business should be incidental. Separate books, incidental means profits used for charity. Separate books, profits used for charity. So that will make it 7 conditions for trust doing business. And now if the trust is doing business in the advancement category, advancement of any other object of general public utility, then there will be 2 more conditions. Related activity and maximum 20%. Related activity maximum 20, related activity maximum 20, making it a total of 9 conditions. So 5 conditions for all, 2 extra conditions for trust doing business, and 2 extra conditions for trust in advancement category. 5 plus 2 plus 2. This is how conditions are going to become applicable. That's the concept of business income of charitable trust. We have already crossed the limit of 2 hours. So here we call it a day. We end our episode here. The next part of charitable trust will be completed with you along with your next episode with your other topics, and we will try to complete volume 1 in episode number 4. Thank you for watching. Thank you for joining. Have a nice time. Good night, please. Thank you very much.